Well, hello and welcome to David Bahnsen's Capital Record, brought to you by National Review, with today a quick talk on a subject that many people forgot about, but nobody should. Fannie Mae, Freddie Mac. The so-called government-sponsored enterprises were very much at ground zero of the housing crisis in 2008 and have come back in the news the last couple of weeks and warrant a Capital Record discussion that will actually be connected to some first principles about what in the world we're supposed to do with this Fannie Freddie thing going forward. Um, I believe there's a possibility that Trump 2.0 may want to address it. In fairness to Trump 1.0, he did have, I absolutely adore, a guy named Mark Calabria, who was running the FHFA that oversees both Fannie and Freddie. And he had some pretty provocative and thoughtful ideas that were bold about how to unwind the government's conservatorship. The Treasury Department has Fannie and Freddie from the financial crisis 16 years later, still in conservatorship. He had some ideas for how to unwind it, but it wasn't really yet the right time. And then, of course, the Biden administration probably would be fine to leave it as it is forever. And I think many would. But now there's some talk that Trump 2.0 could be more incentivized to do something. But what has to be done requires us to understand what happened before. And I want to suggest a few things that are connected to first principles that I believe should serve as parameters for how we think about this going forward. What I will not do is take this great hard-lined sort of libertarian argument, even though I basically agree with it, that says, oh, who cares about the government being involved in housing? People either can afford it or they can't afford it, and governments have nothing to do with it, wash their hands of it and walk away. I don't actually believe that the government should have a big interest in whether or not people buy homes, but I do care about home ownership. I do care about family formation. I do care about stability in the economy. So there are factors here that matter. And regardless of what we think should have happened in years past, if they get this wrong in how they unwind it and deal with it, I don't want to hurt human beings. So I want a thoughtful and deliberative and compassionate, but appropriate resolution. But it requires us to understand what exactly happened. And today I get to do something that is my favorite thing to do in Capital Record. I get to kind of bring together the finance nerd part of me and I think some more principle-based ideological conclusions. So we're going to pull these things together. So let's get our financial wonkiness on. Okay, why were Fannie and Freddie ever created to begin with? They were created by Congress to buy mortgages from banks, not to originate loans. There's already an ecosystem in our country of how loans get originated. You need processors, you need salespeople, you need underwriters, you need people to gather paperwork. Fannie, Freddie don't do that, but they have standards of the loans they'll buy. So there's banks and mortgage companies out there that will go write up these loans, loan money to people to buy homes or refinance, and then they will sell those conforming loans that conform to the Fannie Freddie standards. They're generally pretty conservative and well underwritten and below certain dollar thresholds, and they will sell them to Fannie and Freddie. Now, Fannie and Freddie, to get the money to pay for these loans, they package all these loans together, put them into mortgage securities, and then sell them off to investors, largely banks that can hold them as very high quality assets on their balance sheet. They're called agency securities, and savers can buy them, and sovereign wealth funds can buy them, and pension funds can buy them. And so, right now, I'll give you some numbers. Fannie and Freddie have $4.3 trillion of assets on their balance sheet. Those are mortgages that they have bought, but they have 4.2 trillion of liabilities. Those are the bonds that have packaged these things together, mortgage-backed securities that are owed out to investors. So you can do the math, 4.3 in assets, 4.2 in liabilities. There's about 100 billion of equity in between there. Well, here's the thing. That was all working fine to an extent, but in order for them to have sold those securities back before financial crisis and get them sold at a pretty low yield, people had to believe they were basically governmental. And so the government did a sleight of hand where they called it a government-sponsored enterprise. And they were instituted by Congress. They were regulated by the government. But then they were not given an explicit guarantee. They were given what was called an implicit guarantee. And that implicit guarantee became explicit when Fannie and Freddie became insolvent in September 2008. How insolvent were they? For 4 years after the Treasury Department had to extend them infinite credit lines to pay, they backed fully all of those mortgage securities. So the implicit guarantee became explicit. But so basically, you have way less money than you have obligations. So you have a negative capital. So that means the equity was worth zero. So what they did is they said, we're going to take over this and then give infinite capital to back all these bonds. And then we're going to get all the money we give out. We're going to get paid back 10% on that money. And they got 79.9% of the equity. Let's just call it 80. And then the shareholders kept 20%, but they were keeping 20% of something that at that time had a negative value. Okay. But they didn't put it into bankruptcy because they needed to pay the full back faith and credit of the government was now backing these mortgage securities. All right. Well, basically that wasn't good enough for the first 4 years. The 10% was on the amount of debt, the 10% interest on the new debt that the Treasury Department was giving was not being covered by the net income of Fannie and Freddie. That's how upside down things were. So then they came along and said, okay, you don't have to pay the 10%. You just pay all net income. Well, that was great. But then what happened is all net income actually became a big number. Housing turned around in about 2013. The defaults stopped. The foreclosures stopped. There was a lot more loan origination. People started buying homes and everything got real positive again. So that's all well and good. But now we fast forward to the fact that no debt was reduced because there was not the 10% per se. It was just all net income. Well, let me give you the real numbers here. They have now, Fannie had borrowed a total of $120 billion of rescue capital from taxpayers and has now paid back $181 billion. They borrowed $72 billion at Freddie and have paid back $120. So if you were to go through and amortize this out from the actual period of time loans are extended and the 10% charge, the government has gotten back all the money it paid and 10% per year and an extra $25 billion. So you say, okay, well, now that 20.1% that the shareholders own should be worth something. Are we ready to put Fannie Freddie back into privatization, get it off the balance sheet of the United States government? And keep in mind, there's $146 billion of equity between Fannie and Freddie put together. And Uncle Sam owns 80% of that. So they would theoretically get 80% of $146 billion if they sold this off into capital markets and have already received back cash on cash, the money I've talked about. So you just do an IPO of this, monetize the government, reprivatize, you're out of conservatorship, everybody's happy, right? Not so fast. It's not technically how things sit. Technically, that money is not debt that has been paid back, but it's preferred equity. So the government would have to wipe away the preferred equity in lieu of it being treated like debt, where from a cash on cash standpoint and taxpayer stewardship, they got back everything they're supposed to get and then some, and a big profit on the equity because of the way things went the last 10 years relative to the first 5 years. And it's fair, you could say, for them to get this kicker of another $25 billion because the whole thing would have gone away had they not backed it throughout that period of time. But here's the problem. There is an argument. It's in the government's interest. It's in the kind of social agenda that there still be a vehicle for housing to be guaranteed, mortgages to be guaranteed by some entity other than the individual banks. If these banks can't sell their loans off to another entity, a lot less loans get done. Fair enough. Now, Part of me says, no, I just want the banks to take the risk or investors to take the risk. But I actually don't have a problem with a collective reinsuring the risk. These banks pay a fee for the guarantees from a Fannie Freddie entity. And by pooling the mortgages of all over the country held to a very tight standard, if this doesn't violate any free market principles of mine whatsoever, and it does facilitate housing, it does facilitate the ability of people to get good quality loans if they are good quality borrowers. Now, people could say, why do we need any kind of other entity doing it if just the local bank won't do it? Well, there's tons of reasons why. But if someone says the government does, if the government doesn't do it, no one will do it, that I flat out disagree with. But I agree you need a bigger balance sheet to be able to pool mortgages and allow for a secondary market by there being an entity that can back these loans with tons of capital, tons of regulatory oversight, high standards for mortgage underwriting, to serve as a central depository to be offering. And by the way, I don't mind if there's 3 or 4 of them. There's no reason for it to be a duopoly like Fannie Freddie. There's no reason for it to be a monopoly like Uncle Sam. You can have multiple entities doing it that are in the business of facilitating a whole lot of banks being able to write mortgages and then have a place that they can sell them off to. What can never happen again is something called an implicit guarantee. I want to replace that with what I will call an explicit non-guarantee. That the sleight of hand that tells investors, buy these bonds and wink, wink, the government will back it up if need be. That is the problem, because the government will back it up if need be. You have to eliminate that completely. You say, well, then no one will buy the bonds if there's not a government guarantee. That's not true. If it is properly regulated and properly capitalized, have proper underwriting. Fannie Freddie got in trouble because of a housing bubble combined with what they were doing with their own net income. They were buying good conforming mortgages, but they were then using proceeds from their fees to buy subprime mortgages. Some entity that is held to a higher standard, that is not governmentally backed, properly capitalized, this could work in privatization, and everybody knows it. But there is this desire to keep a good a government good housekeeping stamp of approval on it. It's not necessary. There is no reason in first principles to say, who cares about housing? I care about housing. I don't care about housing enough to give borrowers who can't afford to pay a loan back a loan. I think it's dehumanizing to people. And I think it undermines faith and credibility in our financial system. I care about this whole subject enough to say that where there are people that are not able to afford to save up 100% the price of a home, they want to obtain a mortgage, that there should be a way of doing so. And I don't think the government needs to play a role in it. I think you can have privatized solutions. We have multiple competitors for who will come and insure municipal bond offerings. Okay. There are all kinds of examples out there in the private market that could take on the role of a Fannie Freddie without an implicit government guarantee. You have to have an explicit non-guarantee so that everyone knows there will not be another conservatorship again. Never again will public funds be on the hook for hundreds of billions of dollars. Now, really, it was trillions of dollars, but if you had enough foreclosures, there would have been enough recovery. But net losses to capital, that you risk a negative capital balance of hundreds of billions of dollars. That's where we were for years. It was unforgivable. The moral hazard, the poor stewardship. But do I think we would put the housing market into utter pandemonium to just simply say to every community bank, you can't sell off the mortgages to any reinsured entity, any type of pooled vehicle like a Fannie Freddie? I think it would be catastrophic, but it's totally unnecessary. You can capitalize a well-regulated, well-run entity, but then allow the equity owners and the bond buyers of that entity or multiple entities to be risk takers. And from that capital base, you don't ever again have privatized profits and socialized losses. You have privatized profits and privatized losses, but it could be a very effective vehicle for democratizing homeownership and doing so responsibly. This, to me, is a very fusionist approach to a very important topic. I hope this has made sense. I look forward to your feedback. Thank you for listening to David Bahnsen's Capital Record. I'm going to come back in a couple of days. I want to talk a little bit about the economic implications of the fires, the absolutely awful fires in California, and a few thoughts that are a little less political than what's going on, and a couple economic considerations. Thanks for listening. David Bahnsen's Capital Record.